Tax season is over with. Yay! And hopefully by now you're done celebrating with your tax refund, or you just got over that ulcer from the hefty tax bill that you received. In any event, you're ready to sit back and relax and grab a bottle of wine, right? No, there's still 5 things that you need to do right now that's going to help you prepare for this tax year. And I'm here to help you. Hi, my name is Pia McAdams, and I'm a life-changing consultant specializing in personal and small business finances. And I know it seems like it's a vicious cycle, but I promise you, if you do the preparation right now, it's going to get rid of the headaches and the gray hairs that's going to accumulate this time next year anyway. All right, so let's talk tax time. To help us, we're going to use Plan D as an acronym for this tax year. Now, the P for plan, that means to prepare your records. And the first thing we're going to do, I'm going to recommend, is that you set up an accounting system. Now, I'm of the new millennium age, and so I'm going to recommend a digital, use the QuickBooks Online. But I know there's some of you that, for whatever reason, you just adverse or just don't want to do anything electronic, so you want to do the pen and paper. I don't care how you set it up, but just set up some type of accounting system, something that's going to be effective for you. And then guess what? It's not only important for you to set it up, but you got to use it. Don't wait until the end of the year and then try to put all that stuff in there. I have so many clients that come to me, especially the new ones, where I have to enter a year's worth of data. Now think about it. How effective and efficient is that for you as a business owner? So please set up an accounting system. And guess what? If you don't have time to do it, then hire someone. That's what the professionals like me are out there for. Hire us to do the work for you so that then you can do the things that you love to do. All right, the second thing that we're going to do under planning our records or preparing our records is going to be for you to set up a separate business account, banking account. I cannot stress this enough. Please, guys, stop commingling your funds, your personal with your business. Have a separate bank account for your business. So that way, anytime that you're having any transactions relating to your cash or your checking account, is all going to be your business expenses. And guess what? When it comes time at the end of the year, because I know no matter how many times I stress the importance of setting up that system, there's still going to be some of you out there that's going to wait until the end of the year. But at least if you have bank statements that's exclusively for your business, it'll be a little bit more easier than having to go through line by line, trying to categorize and separating the business from the personal. So please have a separate business account, a business banking account. And likewise, guess what comes next? A separate business credit card. Yes, yes, yes. Please, please, please stop commingling those funds. Have everything separated. Now, I know you guys, if you're just, don't know anything about accounting, but trust me, you're violating one of the major rules of GAAP. And GAAP stands for generally accepted accounting principles. And one of the assumptions is that you're going to keep your business and your personal separated. Okay, so please stop violating that rule for us that's in the industry. Okay, so stop commingling those funds. All right, so that's your P. Now, the L underneath the Plan D is going to be a list of questions. Okay, this is a list of questions that you're going to have for your accountant or your tax advisor. Now, let me just ask you this. How many of you guys, and I want to hear this in the comments, how many of you guys just go see your accountant or your tax advisor just once a year, and that's generally around tax time? Oh my gosh, you're doing yourself and your business such a disservice. You should be seeing your tax advisor at least 4 times a year, quarterly. Why are you waiting to the end of the year and being reactive as opposed to being proactive by making sure that you're staying on top of things? So please see your tax professional more than once a year, okay? At least twice, preferably 4 times every quarter. All right, but with the list of questions, what you're doing is you're analyzing your records and you're looking at what happened last year. And were you happy with the outcome? Were there things that you could have been doing differently? And that may be one of the questions that you write down. What am I currently not doing that I should be doing that's going to help my tax situation in the upcoming year? Okay, so that might be an example of a question you may ask your tax advisor. Another question could be, based upon my type of business, are there any expenses that I'm missing out on? Okay, because again, if all you're doing is seeing your tax advisor once a year and it's during tax time, well, guess what? That person is busy, is right in the middle of the season, and so they have a lot of clients, and they may or may not even know you, depending on if you go to the same person or you just go to anyone that will do it for the cheapest price available. I understand, trust me. Okay, but just make sure again that you ask them based upon your type of industry, are there some expenses that you may be missing out on? For example, I have clients that come to me, and although the home business office is like now everyone knows, it's like a household name when it comes to taxes. A household tax deduction is the home business, right? And there's guidelines that I'm not going to go into detail with here, but there are specific guidelines to make sure that you qualify. But let's assume that you do qualify for the home business expense. Well, a lot of times what people don't know is that includes all of the household expenditures, not just the mortgage and not just the property taxes and the utilities, but what about repairs? So anything that you're doing with the house, let's say that your home office is 5% of, 5% of your whole house that your home office is. Well, that means you get to deduct 5% of all your household expenditures, okay? So little small things like that, and that's not necessarily specific to any business. That's, if you have a home office, that's all businesses, but there may be some expenditures that is exclusive to your type of business that you may not know of, okay? But your tax advisor should. So then write the question down. There's a myriad of questions that you can be asking, but obviously this is going to be more effective if you are seeing your tax advisor on a more frequent basis. But write those questions down. All right, now moving right along, the A. The A stands for analyze for accuracy. And what are we analyzing? We're analyzing our statements. And the first one we're going to analyze is the bank statement. I want to hear from you guys again. How many of you guys reconcile your bank statements on a monthly basis? Don't lie, I know. Tragic, tragic. I tell my clients, humans make mistakes, right? We all know this. We all make them, right? Well, guess what? Humans work at banks. Therefore, guess what? Banks make mistakes. Yes, they do. Do not assume that just because you get the bank statement and you're visually just going through your checking account every once in a blue moon because you have an idea right up in here what you have, don't assume that that's correct. The purpose of reconciliation is to verify that what the bank says you have and that what your books say you have, that they're in alignment, that they agree with each other. Now, let me just say that for those of you that have never done bank reconciliation, I'm not saying that your bottom line initially is going to agree. In other words, your bank balance is going to say something different than your book balance, and that's because of transactions that that are in transit, if you will. Like, for instance, let's say there's some deposits that you put in your book that you made to the bank, but the bank hasn't recorded them yet. Or there may be some checks that you've written out of your books, which is going to reduce your book balance, but they haven't cleared the bank yet. So the bank balance may say a little higher than what your book balance. But the purpose of reconciling is at the end, no matter what the balances are, guess what? They're going to come and end up together. It's not frequently going to be this way, where this is your book and this is your bank, but it could be, no matter what. When you're reconciling, you're making sure that they end at the same number. And guess what? That goes likewise to your credit card statements. Please, please, please look over these financial statements. And I know you're like, Pia, I got so many coaches, or I got so many, I got jobs to do, I got clients to see or whatever. I don't have time to do all this. You have to make time for your business, right? Why are you in the business? What is the purpose of it? Well, the purpose is to serve. Well, guess what? Who's the best person to serve? Yourself first. You know how we go into on the flight and it says put your mask on first before you put it on even your child? You got to take care of yourself first. That means if you really want to service your clients, that means you need to stay in the business so that you can service your client. So I'm trying to help you stay in the business. So do the business side first. And again, if this is something that you don't want to do, hire someone to do it. But I always tell my students, because I'm also a professor of accounting, do not ever trust anyone 100% with your books. In other words, ask those questions, okay? Question. All right, so the third thing that you're going to analyze are going to be your financial statements, okay? You want to, at least on a monthly basis, should be getting your income statement and your balance sheet. Now your income statement is going to show you what your net profit is. Hopefully there is one for each month. Okay, so we're talking about a monthly financial statements. So you just want to look over those and just make sure that your income is correct and that the expenditures are also shown correctly. And then on the balance sheet side, your balance sheet shows your assets, which are the things that you own. It shows your liabilities, which are the creditors or the people that you owe money to. And of course, it's going to show your equity, which is the result. Meaning if you take everything that you own, your assets, and you liquidate them and pay off all your liabilities, which are your debts, what's left over is your equity. That's what's shown on your balance sheet. So you want to analyze these financial statements because one, you're going to check for accuracy, and two, it's going to give you an indication of how your business is doing on a monthly basis. You don't want to wait to the full year to find that information out, right? At least I hope not. And then finally, well, it's not really finally, it's finally for the plan portion of the Plan D. We have the N. And the N stands for to note the tax law changes. Guys, the devil's in the details. And when it comes to the tax law, there are a lot of details. And it changes constantly. And you need to be up to date on these changes because it's going to affect you and your business. Now, I will say as a shortcut, if you do see your tax advisor, your accountant on a quarterly basis, guess what? He or she can help you out with that information. But if not, it's going to be on to you to make sure that you keep up with what's going on. All right, so that's very, very important. Now, we come to the last letter, and that's D as in dog. Well, I'm pretty sure that you've heard the mantra of the real estate agents, which is location, 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 right? Well, guess what? We as tax advisors also have our own mantra, and guess what it is? It's D for documentation, documentation, documentation. Document every single thing. Keep your receipts, keep your invoices, keep your bank statements. And guys, please get rid of the old shoebox. Don't put it in the shoebox. At least organize it if you don't have your accounting system, which you still need it as well. But at least organize it in a Concordian folder where you can at least keep it separated out, okay? Don't just throw everything in the shoebox and say here and give it to your tax advisor at the end of the year for them to finagle through it. I mean, because otherwise, remember that ulcer we talked about, that hefty tax bill? They're going to charge you for it. Get yourself organized, okay? This is your business. All right, so document everything because in the unlikely event that you were to get audited, guess what they're going to be looking for? That documentation. Well, let's kind of backtrack and say that you really don't have the documentation, but you took my advice and you opened up a separate bank account and a separate business credit card account. Guess what? That will suffice like 9 times out of 10. Now, I'm not an IRS agent, but I have heard that and also read that when it comes to the business, if you don't have, let's say, specific receipts of every single thing, but it is documented in the bank statement and your bank, again, is all business expenses and you can, of course, substantiate that, then that's going to work for you. Otherwise, keep those receipts. And I get it, all these little pieces of paper. Guys, we're in the digital age. You don't have to do that anymore. Guess what? You can use this little device right here. This is your camera. This is what I tell my clients to do. Whenever you have a receipt, take a picture of it. I know with my camera, I have it automatically downloading to Dropbox. So all my receipts go to Dropbox. And then I have my assistants sort them out. Okay, but at least if you have it all digitally stored, you don't have to have all these little pieces of paper just running around. But make sure that you document it. All right, so understand that when it comes to the unlikely event that you were to get audited, the auditor can actually, or the IRS can actually audit your records for the last 3 years from the date of your return, okay? Now, if they suspect fraud, guess what? It's 6 years. So that's why we recommend that you keep your records for a minimum of 7 years, okay? So that's 7 years of keeping all those records, but remember, you can do this digitally. All right, so that is my 5 Plan D step to help you get organized for this tax year. Hopefully this information has been helpful to you. Again, my name is Pia McAdams, and it has been my pleasure servicing you. Goodbye.